And welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture in journey towards financial freedom. They will cover financial products, financial well-being, so you, like me, can reach your goals sometime in the future. Now let's get into the latest video. Now for those of you new to investing, shall we say, the idea of creating an investment portfolio may seem daunting and frightening at first, but it shouldn't be. You just need to get the basics right, and ultimately it depends on two simple things when starting on your investment journey. Firstly, your attitude to risk and your level of investment knowledge. Okay, now these two factors alone will determine how you start off and result on what you're going to invest in, whether it be any savings, a nest egg, inheritance, or let's just say monthly contributions. Now, before you start off investing, the simple thing they should say is build some kind of emergency portfolio. Now, it may well be 3 months worth of bills, it may be a set amount. I personally like to have a minimum of £1,000 and an instant tax and savings account, but my wife keeps a lot more money than me for a rainy day on a joint basis based upon her tolerance to risk, but we're happy with that level. Now let's get into the sort of assets or portfolios you should hold to create what we call a sizable or secure portfolio. Now, ideally, your first starting point, shall we say, cash. Now, it may be you hold what, let's just say, 10% in a cash deposit fund. It may be a bank or bill society account, it may be a simple cash ISA. But you're doing it for one reason, shall we say, an emergency fund. It may be to purchase your next holiday. It may well be, shall we say, treat unexpected expenses. It may well be just for some kind of comfort security. You can get money in an instant. No fees, no charges. Okay. But what about if the market suddenly takes a dramatic event? Can you use that money as some kind of advantage? Can you then go and buy what we call good quality stocks, some kind of funds at a reduced price, which ultimately results in a lowering buying price? So can you take advantage of having cash on a short-term basis, so if the market does have a sudden dip or a recession, you can take advantage in a short-term instant scenario? Where should you hold money? Well, nice and simply in some kind of ETF. So ideally, let's just say 50% of your portfolio. Now, if you're new to investing or you're not considered yourself seasoned or brave enough to buy what we call individual stocks, you may buy what we call the whole of the market through a simple low-cost ETF, whereby it will purchase numerous indices around the world, or let's just say the S&P 500 will buy the top 500 in the US, or the FTSE 100 will buy the top 100 companies in the UK based upon market capitalisation, thereby giving you greater diversification and creating a less volatile or risky portfolio. Now, these funds are normally done on a collective basis, shall we say, and the fees are a lot lower than active management fees, and the vast majority of the time they will probably give you better returns. Second, the S&P 500 has produced an annual return of around about 8% since inception many years ago. So you'll have good years, you will have bad years, but you can just switch off, okay, and avoid so-called market noise, so-called short-term distractions, and you'll be rewarded handsomely if you, shall we say, think and invest for the long term. So do you pick a simple fund and just switch off? Now, two simple funds I'm going to give you some examples of I use personally myself. One is through my platform provider, AJ Bell. It's what we call an adventures fund. Okay, now it has a fee of 0.31% and it has produced annual returns of 8% for the past 5 years. Now it invests in around 20 indices around the world, with the largest holding being the S&P 500 of about 19%, emerging markets about 19%, and the FTSE 100 at 16%. Okay, but as we said, it was done for diversification, and look at the following chart. It will cover numerous sectors across a worldwide basis. We can just switch off. Now, another fund I've been purchasing recently is the Fidelity World Index Fund. Has an even more reduced fee of 0.12%, but it holds 1,510 stocks, okay, around the world, and it has produced an annual return of 8.88% across the past 5 years and 11.51% for the past 10 years, with around 73% of the portfolio based in USA, 18% across UK and Europe, and 10% in Asia. Now, there are lots of funds, ETFs. You can buy from your own platform providers, shall we say. You can buy directly from companies, let's just say from Vanguard, the biggest player in the world, BlackRock. Okay, but these are two funds I am personally happy with. Okay, I can just switch off knowing I can just track the markets in good times and bad times. Does what it says on the tin. There is an investment risk, but it was done for diversification. Now, shall we say, buying ETFs or funds, where should we invest next? Well, it may well be in what we call blue chip stocks. Now, when I started invested, I jumped straight into the deep end and purchased single companies. Okay, what we call blue chips within the UK. And these shares are part of the FTSE 100, the top capitalisation shares in the UK. Now, I was happy to do this, shall we say, and you may well do the same based upon your investment knowledge and your confidence improved. But remember, do your due diligence, okay? Do your background checks. What are the finances of the companies? Is it profitable? Does it reward shareholders by paying a dividend, let's say each year, semi-annually or quarterly? Is the company growing, shall we say, and does it improve revenues every year? Has it got some kind of moat or security? Now, a simple example may be a company that's been around for 100 years and will still be there in another 100 years. Okay, may be considered safe, secure, boring, but it does what it says in the tin. Okay. Now, as my portfolio has grown over 6 figures, I do reinvest all my dividends into individual shares. So the dividends will be compounded each year. Okay. But any new money I put in, I now put in, shall we say, into ETFs because my portfolio was originally so focused in the UK. And let's just say as a side issue, the UK economy has not been the greatest performing market within recent times. What sort of companies may you buy then, shall we say, on an individual basis? Now, my portfolio is mainly, shall we say, based in the UK. I've got 10 holdings within my self-invested ISA and 10 companies within my SIP. Okay, but I've done it for my own, shall we say, reasons. Okay, now, my largest holding is about 10% within the portfolio. Okay, but I invest in companies what I know about, shall we say, financial services. So it's Lloyds, Aviva, Legal and General, HSBC. Now, some of them are paying very nice yields of around about 8%. Okay, I do also own shares, shall we say, in BP, Shell, NatWest, Sainsbury's, and some smaller growth stocks, but they are shares what I'm willing to hold for the next 5 years. I have no reason to sell. Okay, so let's look at some individual examples. Firstly, Royal Dutch Shell. As we can see from the chart, the last 5 years, it has had some roller coaster rides, mainly because of the Russia-Ukraine conflict. But it has recovered recently, and it does give a very good dividend yield of around about 5%, which we reinvest within cash within our portfolio. But it's the largest holding, shall we say, in the FTSE 100. Another holding may be the second largest company, AstraZeneca, the drug producer, which has nearly doubled over the past 5 years. And again, it does give a dividend yield. Okay. What about another company, Diageo, the drinks, the premium drinks producer? Okay. Again, does give a very nice yield, let's just say around about 3%, but the share has returned 58% across 10 years. So just some simple examples, shall we say, of good quality companies will be here for 100 years, will still be here in 50, 100 years because they've got a moat, they've got a brand. Okay, they are still growing revenues, they do pay some nice dividends. Another company, shall we say, may be HSBC. Although it's UK listed, it does have a very large presence in Asia, and it's just, shall we say, although the share price has reduced a small loss over the past 10 years, it's mainly due to recent events, let's just say China and Asia, due to prolonged COVID restrictions that are in place. But it is a very cash-rich company. It does pay a yield of 6%, and it has just reinstated quarterly dividends, and it does pay a special dividend, will be in spring 2024, want to offload some assets and business in Canada to streamline its business, but could it be seen as a good buying opportunity at current prices for a long-term hold? So that's just simply some simple examples of some companies you can hold. Good quality companies, shall we say, producing very good results, very good dividends, growing dividends, can they be seen as a buying opportunity for long-term portfolio performance. That may not be considered, shall we say, blue chip within the UK. Now, it may well be going to growth stocks, so it may well be you want to put some kind of percentage, let's just say 10%. Now, as your knowledge grows and you're happy purchasing single company stocks, you may venture further afield and buy what we call growth stocks. Now, these may be companies in the FTSE 250, which may start off small. They have grown rapidly over the past few years, and they may continue to do so in the coming years, based upon their growth, their future expansion plans, purchases and acquisitions, or do they produce quality products which are currently in demand with consumers at the moment. So they're having, shall we say, a very good track record over the past few years. Okay, we all know some good companies, and again, some simple examples. Now, a recent purchase I've made in the past, shall we say, is JD Sports. It is very cash rich. It has over £1 billion in cash reserves. Now, it did start off, shall we say, as a small shop in the base of North England, but it now has a global presence, and it now operates across numerous countries, shall we say, around the world. It has expanded recently, shall we say, in Asia and America, and it's about to buy Iberian Sports Retail Group for £543 million in cash, solely funded from cash reserves. Now, it does pay a small dividend, but it's seen as a growth share. And let's just say in the past few years of holding, that share has doubled in value. So an great example, it did start on the high street, it has remodeled itself, it's very cash rich, but it's expanded into other companies, and it is a growing company. Another example, shall we say, may be Greggs the Baker. As proved by the cost of living crisis, people's habits have changed. But the company is very cash rich, and it has been increasing, shall we say, its heightened presence by opening new stores. Now, it has recently been expanded into what we call retail parks, service stations, but it has adapted the menu to improve the number of items for sale. But it's also now opening later to meet a new client of customers, shall we say, which is never done in the past because it was solely high street based. So again, a great example of a cash-rich company that has adapted to the current market times, and the company has increasing dividends at the same time. At the moment, it pays a dividend, let's just say, around about 60 pence a share, which is a yield of 3%. But it is, shall we say, increasing around about 150 new stores each year, say, on a cash-rich basis. Now, these are just two simple examples of companies I purchased in the recent times as a result of doing some research and doing some background checks. Now, you can do the same. Now, it may well be you avoid so-called penny stocks or low-value company name, but there are some great companies around there within the FTSE 250. So can you take advantage of these opportunities and again, purchase some great companies at a reduced price and hold on to them for several years? You will be rewarded handsomely. Finally, as your assets grow and your knowledge improves, it may be that you buy so-called more adventurous assets. Now, it may well be that consider what we call precious metals such as gold, silver, palladium. Now, it may be in the form of a single coin, shall we say, where you buy, let's just say, a 1-ounce sovereign in the UK for about £30. It may well be you can hold it less for a lot less more if you don't pay VAT or a company holding on your behalf. Or it may well be you buy what we call a gold sovereign. Starts off around about £400. Let's just say to gain to a 1-ounce sovereign of about £700. Okay. Now, it may seem excessive, shall we say, for each coin, but gold has been around for thousands of years and is considered a safe haven when times are tough. And as we've seen, unfortunately, due to recent events, shall we say, in the conflict of Israel, gold has gone up in the past week around about 5%. So it's considered as a safe haven. Okay. Now, as you can see by the following chart, the price of gold has gone up, let's just say, from $14.54 an ounce to $16.66 an ounce. So an increase in the past 12 months of 12%. A simple example, shall we say, silver may be if you're looking for mature silver. Silver's gone from £16.52 an ounce to £19.17 an ounce. Again, an increase, but this time 16% in the past 12 months. Okay. Now, I personally purchase 1 silver ounce per tender coin every payday for around £30, and I'm happy to store it myself. But let's just say it's done to the first portfolio. But any profits I receive in future are free from capital gains and free from inheritance tax because I store them myself and I've bought specific coins. Okay. Now, this may appear somewhat speculative, but it's something I've only started during 2023. and at present it makes up less than 1% of my current portfolio. Okay, but this is something I'm happy to do. I'm considered as a seasoned investor, and I'm comfortable making that decision based upon my attitude to risk. It may well be you don't do it, shall we say, but it may be something not considered. I say to diversify your portfolio, as gold and silver may be considered a safe asset. Find yourself a platform provider, shall we say. Do you hold it yourself, or does someone hold it in storage on your behalf? Now, hopefully this video has given you some insights into how to build a so-called bulletproof portfolio. It will have good months, it will have bad months, it will go up and down in value, but the aim is to invest in a consistent basis and think long term. Now remember, if I can build a sizable portfolio, you can too. You just need to take the appropriate steps, the appropriate action, create an action plan, get some goals, and think long term. Remember, if you like the videos, smash the like button, subscribe to the channel, and we'll see you again soon.